सेव किया था ना?
मैं सिर्फ इसलिए गया था क्योंकि उसने मुझे कॉल किया, that's it. But listen though.
Save it for someone else.
जिंदगी में सेव करना जरूरी है, मगर जब बात पैसों की हो, सिर्फ सेविंग से काम नहीं चलेगा। इक्विटी म्यूचुअल फंड्स में इन्वेस्ट कीजिए और अपने सेविंग्स को आगे बढ़ने का मौका दीजिए।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello and welcome to this episode of Macrosutra. I'm TCA Sharad Raghavan, Deputy Editor at ThePrint, and this time around we're going to take a step back from our usual topics of the economy, how inflation is doing, how industries are doing, how services are doing. We're going to look at something that moves quite a bit faster, which is the stock market. Now, we know that the stock market has been falling over a little while now. In fact, as of today, it's lower than what it was at the end of June, as per the latest data. But why this is happening and what the future outlook is, that's what we're going to discuss. It affects all of us. Increasingly, we've been putting our money in the stock market. That's what the data also shows. So let's get on with it. And to discuss with us, as always, we have Radhika Pandey, Associate Professor at NIPFP. Thank you, Radhika, for joining us.
Thank you, Sharad.
So now, Radhika, the first question is that we know that the markets are falling, but has it been a short-term thing or has that fall been recorded over a longer time period?
So if we look at the data, and the main data is to look at the returns, what is happening to the returns of NSE,
Right.
Nifty and the BSE Sensex, where we are taking the difference between the index value today and the index value last month.
Right.
And if we look at that, then we saw that in September, the markets were doing well. Markets generated positive returns. That means
Okay.
September end was more as compared to August end.
August end, I see.
Of course, there are variations, but overall September did well in terms of markets. It's only in October we are seeing that consistently markets have been falling. Like today is the 6th day of consecutive sharp decline in the stock market indices. So while there are bouts of volatility across various months, particularly on some days, especially when there is some monetary policy announcement or if there's some unfavorable announcement, but then the effect tapers off. But here we are seeing that in October, we have seen a consistent period of market slide happening, not only in India, but across other jurisdictions as well.
Right. I was actually going to ask you that. Is this happening in India? As you said, it's not. So it's happening in other markets as well?
Yes. So if we compare the returns across various jurisdictions, normally we see it's a mixed phenomenon. Like some markets do well,
Right.
some markets do not do well. Sometimes China doesn't do well because of its the weakening policies and the weakening economy and inadequacy of stimulus measures. Sometimes there's some economy-specific factors that impact certain markets of some countries. But interestingly, in October, across the globe, if we look at some of the major markets across both advanced economies as well as emerging economies, we are seeing that they are in red. So what we have seen is that 23rd October comparing with September end, because we have not yet completed October, the latest data shows that most of the markets are not performing well. In fact, they have in terms of their values, the index values, they are below the levels seen in the previous month.
Right. And now, has India done better, worse? Is that possible to say?
Yeah. So India has not done as badly as some of the other countries, and we can delve into the reason. So there are other countries that have done even worse. For example, China's slide is much more deeper as compared to India.
Of course.
So there are other countries also where the markets have slid much more as compared to India. So India falls somewhere in between.
Okay.
So
there are a lot of markets that have not fallen as much as India.
India also, yes.
Right.
But what it tells us is that there are a set of common factors which have been impacting these markets, because there is a sense of this understanding that there are some domestic factors, but what is happening is that across the board, when you see markets are falling, that means there are some common factors that have been impacted all these markets.
Right. And now that lays us very well to ask the next question, which is, what are these factors? Now, first the international, and then the ones that are domestic and unique to India.
Yes. So first talking about international, one of the main factor is the uncertainty arising, of course, due to the Hamas-Israel war. That has led to uncertainty, that has impacted market sentiments, that has led to a risk-off strategy, because whenever such unfavorable events happen, investors tend to lock in their funds in the more safe haven assets.
Right.
They tend to withdraw their funds from emerging market assets like India, which are considered to be relatively more risky as compared to the safe haven asset.
So this would have also happened right after the Ukraine
Russia,
war started.
Absolutely, it happened
Right.
during that time also. But this time around, what is happening is that there are these concerns that it may escalate, it may spread to other countries. And if Iran also gets into this, if Iran also gets involved into this, then it will lead to a sharp upsurge in oil prices,
Right.
because then the US will impose sanctions. So there will be sharp upsurge in oil prices. And therefore, those countries or those markets that are heavily dependent on oil,
Which is
their
like us.
market, which is ours. So their markets will tank badly. So
Of course.
that is one concern, that is one sentiment that is playing out widely in markets as of now, because we are seeing uncertainty across this event. There is this concern that it might escalate, it might spread to other countries. So that has led to concern around commodity prices, inflation,
Right.
market sentiments, and that is one major reason that is impacting markets across the board, because oil prices is something which features in the monetary policy decisions of a number of countries, not only India.
Right.
Even the US features in their FOMC discussions. We see that oil is one of the factor, natural gas prices is one of the
course.
factor. So this is one factor that impacts market sentiment. But the more important factor which has been playing around for quite some time now is the other developments in the US. So that is something that require greater scrutiny. That is something that requires a more deeper discussion.
Right.
Now, in the US, there are 2-3 events that are happening at the same time that has led to increase in their bond yields.
Right.
The 10-year bond yield, which used to be hovering around 3.5% till June, July, is now in the range close to 5%. In fact, it touched 5% during early this week. On Monday, it touched 5%.
And sorry, just to explain to our viewers who might not know, a bond yield basically is the return that you get from investing in that bond.
Yeah.
So it's a gauge of how attractive that bond might be,
Correct.
because the higher the yield is, the more attractive it will be.
Yeah.
That's the higher interest you will get from investing in it.
Yeah, and because it's a US bond yield, it is more attractive. It is the most significant asset
Right.
across the financial markets. It is the most significant. It is the most liquid. So if the US bond yield starts offering higher return, we see a reallocation of portfolios happening, where foreign investors tend to dump emerging markets assets and tend to move towards the US. So
Right.
we see that this kind of a inverse relationship happening between the bond yields, that means the returns on bond, and the stock market performance.
Right.
Now the question is, why is the US bond yield rising? Why it is that it has risen to 5%? And there are two important reasons for this.
Okay.
One is recently the US Fed Governor Jerome Powell made this statement, that he made a hawkish statement that despite the fact that inflation has come down, it is still above the target, and
Yes.
therefore interest rates are likely to remain higher for longer. So
Right.
that was a that was a remark that caught the markets by surprise, because market was anticipating that the US Federal Reserve is at the end of its rate hike cycle.
Right.
So now if the interest rates rise, that means markets anticipate that inflation is going to remain higher. Now, if inflation is going to remain higher, that means that investors will ask for higher return on bond.
Of course.
Because the value of money goes down, so they will ask for higher returns on bond. So that is why the bond yield is rising.
Right.
That is one immediate reason, or what is called the short-term reason. But a more deeper reason is relating to the fiscal framework of the US. What is happening is that their fiscal deficit has risen to record level, touching almost $2 trillion.
Wow.
So 1.7 to be precise, $1.7 trillion. So their financial year ends in September.
Yes.
So their financial year ended in September, and their fiscal deficit came in at $1.7 trillion, which is almost 6.3% of GDP.
Right.
Almost the levels which used to happen, we used to see around the global financial crisis. So that means now if the fiscal deficit is high, it means that they will have to issue more bonds.
Of course,
they will have to borrow more. They will have to issue more bonds. The treasury will have to issue more bonds. So that means that if they have to issue more bonds, they have to offer a higher interest rate
to make it attractive.
Because demand is stable but supply is more. So you need to offer higher interest rates.
Right.
So these are the two reasons that have led to higher bond yields in the US and has led to kind of reallocation from emerging markets to advanced economies.
Now, this reallocation, I mean, of course, the bond yields are one major factor. Could it also be that due to uncertainty, people move their funds to a more stable economy?
Yeah, absolutely. That is true. And even within India, if we see what are the FPIs doing, or what are the foreign portfolio investors doing, they are also shifting their funds from equity to debt.
Which is more stable.
Right. So even within India, we are seeing that while FPIs have been net sellers from equity, that means they are selling more and buying less, therefore they are net sellers, but in bonds or in debt instruments, they have been net buyers. So, and there is, again, we can talk about the reasons, because Indian bond yields have also inched up, mirroring the trends in the US bond yields. So we can talk about the reason. But coming back to the US, one more interesting point at this point is also that what is the Federal Reserve doing? Federal Reserve is now unwinding its quantitative easing.
What it did during COVID.
So what it did was that across all central banks, even the RBI did that.
Yes.
That to support interest rates, it bought government bonds and it infused liquidity into the economy.
Right.
Now they are reversing that trend in the sense that they are getting rid of their government bond. They are selling government
So
bond.
again, there is a supply surge.
Right.
So
at a time when Federal Reserve or central banks would have been expected to support the government's borrowing program, it's not helping. They are in fact complicating the conduct of the US Treasury, because they are also offloading their bond because they cannot afford to hold. They have to also suck out liquidity and do quantitative tightening at a time when inflation is high. So this is a complicated mix of policies that is happening in the US, which is causing the interest rates to remain higher for longer. So the point here is that in the US, it's not expected that the interest rates will come down anytime soon. They are likely to remain elevated. And so markets have to embrace for systematically higher interest rates in the US and other advanced economies.
Right. Now, looking at India, going from your article, there's at least one reason that's happening within India that is leading to the markets kind of falling.
Yeah. So we spoke about the oil price rise, which is potentially due to the escalation of conflict, and earlier because of the production cuts that were announced by Russia and Saudi Arabia.
Right.
We are seeing that crude oil prices have been hovering above the $90 per barrel mark. So that is one. The other is the US Treasury bill upsurge. The third is also, if we look at the sectoral indices, if we look at the within the broad market, how are the various sectors performing? There we see that the IT sector has not been performing well, and that is something that has dragged the stock market, and that has again something to do with the global uncertainty.
Markets,
We saw IT companies like Tech Mahindra's results coming out yesterday. The performance was muted. Other IT companies' performance is muted. So that has also dented market sentiments and has led to slide in the market.
And overall corporate performances in Q2 have not been great.
Yes.
Right?
So as of now, I think around 200 firms have released their second quarterly results. And what we see is that their top line, in other words, the sales revenue is not very great.
Right.
So that is also something which has dented the market performance. So international factors as well as some domestic factors.
Right. Now, in theory, and again, this is only theoretical, not really practical, but if bond yields in India were to
Right.
exceed the US bond yields, then we could expect a reversal and that funds would start coming here.
Yeah, so our bond yields are more than the US bond yields. That is
Right.
there. But what has been happening during the last few months is that this differential has been narrowing.
Because they're rising.
Because the US bond yield has been rising much faster. Indian bond yields, the 10-year bond yield, because
Right.
that is the benchmark or the what is used for the purposes of comparison,
Right.
because it is the most liquid bond. So we look at the 10-year bond yield of the US and of India. So we see that while Indian bond yields are more than the US bond yields, but the differential has substantially narrowed over the last 1 year. It used to be somewhere, the difference used to be somewhere around 4.5% to 5%.
Okay.
Now it's less than 3%.
Oh, wow.
So that
Okay.
has also led to reversal. And now we are seeing that the Indian bond yields are also inching up. And the main reason for this is that in the last monetary policy, the RBI governor announced that they will be doing open market operations.
Yes.
So what is open market operation? That means the RBI will sell bonds to absorb liquidity, because there could be a sharp surge in liquidity during the festive season. So they did not commit, but they just said that they could consider doing an open market operations to absorb liquidity, and that was taken as a sign of a monetary policy tightening,
Right.
and has led to yield increase in bond yield. So that is what we are seeing within India. Also, we are seeing that the foreign investors are offloading their equity holdings and buying more of debt.
Right.
The attractiveness of Indian bonds has increased over the last 2-3 months. We are seeing that. And in fact, the bond inclusion news that we discussed earlier, that has also improved the attractiveness of Indian bonds for
Right.
foreign investors.
So then let me get this right. Our Indian bonds have become more attractive compared to Indian equity,
Yes.
but US bonds have become even more attractive compared to Indian bonds.
Yes.
I see.
Yeah.
Okay.
They have become more attractive. Why? Because in absolute term, their yield is lower, but that
Right.
differential has substantially narrowed, and therefore, and because they are more safe haven assets,
It's the US.
and there is less of exchange rate risk involved with the US bond. So foreign portfolio investors have shifted. So they would want the differential to be somewhere around 4 to 5%.
Right.
But because that differential has narrowed and the US bond yields have moved closer to the Indian bonds, so that has resulted in this
Right.
exodus.
And now we have one question from the audience, which is about another possible cause for the stock market falling or funds flowing out of India, which is the stock market losing value because the Indian rupee is weakening against the US dollar and because inflation here is a little more suppressed? Or, as you said, is it because the US bonds are giving good returns?
Yeah, so it is, the more important factor is that the US bond yields are giving more returns, and the US dollar index has been rising. So it's not so much that the rupee has weakened, it has weakened, but the US dollar index has risen.
Has
So
strengthened.
the US dollar index has risen, it's touched around 106, which is a sharp uptick from the normal levels of around 101, 102.
Okay.
So that has resulted in stock markets falling. So it's mainly the developments in the US that are shaping the stock market performance of the emerging markets economies.
Right. So now that was a question by N. Shekhar, and we have another question by Sankalp, which is that now we are seeing a phase of volatility right now, but don't you think the Indian stock market is less volatile today than, say, some years ago? And he says that unless we see a major black swan event happening, a market crash is unlikely to happen.
That's true. That's very true. And in fact, if we to look at volatility, what do we look at? We look at an indicator called VIX.
Right.
National Stock Exchange, VIX. It's a gauge of the stock market volatility. Higher this value, higher is the volatility in the market. And yesterday, in fact, that is Wednesday, we saw that intraday the VIX rose by 3.5% in one day itself.
Wow.
So that is an indication of higher volatility. But if we see across the month, if we see in October, it's not so much volatile as compared to September. And the main reasons for that is that the domestic investors have been cushioning. That means they are still buying stocks. It's not that while foreign investors have been selling equity because the US bond yields have turned more attractive, but within if we look at the domestic institutional investors, particularly the mutual funds,
Right.
with the latest data, what we see is that in fact, there have been some days when they have also turned net sellers, but overall they have been net buyers. So
Okay.
they have tried to, they have tried to cushion the impact of the exodus by FPI. So had it not been for these domestic investors, as well as retail investors, as well as institutional investors, the slide would have been much sharper.
Much sharper,
So that
right.
is very true, and that shows the maturity of the market. Even now, it's not expected. There is the kind of slide that we are seeing in other markets, we are not seeing here because the fundamentals are strong. But these international factors are likely to remain, and because they are very fresh events as of now, we are seeing this impact. But slowly, I think these events will get factored into the sentiments, and the markets will stabilize at a level.
Right. And now this is the $1 million question, which is that when can we hope for this market slide to reverse itself and again start rising?
One of the main reason is what is the commentary by the US Federal Reserve, because that is something that is keenly watched by the investors, that when do they expect that interest rates would start likely to fall, or if they give some dovish outlook about inflation and interest rates, that will help in reviving the sentiments of the markets. And the other thing is when there is some clarity on the war front, what is happening on the war front. If there is some clarity, then that will help in reviving the sentiments. But there is this period of uncertainty for these days when both the events are playing out. The bond yields are also rising. There is uncertainty on the war front also. There is uncertainty on the commodity prices front also, because sometimes the supply shortage overweighs, sometimes the demand, the suppression in demand tends to bring down the prices. So it is a volatile phase, not only for the markets, but also for the commodities as well as for the currency. So we are seeing that the rupee is also weakening. Sometimes it rises. So this is a turbulent phase for all financial assets.
Right. So there you go. The stock market has been falling. Some of it has to do with domestic factors, such as that our own corporate performance hasn't been as strong as we would have liked in the second quarter. But the bulk of it has to do with what's happening outside India, especially in the US. The bond yields in the US have been rising, and that is drawing a lot of foreign investors away from emerging markets like India and other emerging markets to the US. And so that's why our markets over here are falling. But apart from that, there's a lot of uncertainty over oil prices, especially because of the Israel-Hamas war that's happening. And we don't know what the outlook on that war is, whether if Iran gets involved, then oil prices could really surge. If it doesn't get involved, how long will the war go on? So there is considerable amount of uncertainty. And whether looking ahead to say whether this market slide will be arrested, we're going to have to wait for a few indications. One, what the US Fed announces the next time around. Two, if we have any sort of insight into what happens with the war. But as of now, the market is sliding. Confidence seems to be down. And on that note, that's all we have for you. Thank you so much for watching.